So we get the first glimpse of Wall Street's latest quarter from Jefferies. Jefferies has come out with their results, their first quarter results, which go through the end of February. So it gives us an idea what the first two of the three months for most of the rest of Wall Street will look like. And Anthony, what do they look like?
Well, they're looking pretty good, actually, at least compared to what we had in the last 6 months of last year. Revenues are up 36% across the board.
And when you say that, you're doing sequential revenues from the fourth quarter.
So
okay.
from the fourth quarter.
And their fourth quarter ends in November, like the old
exactly.
Wall Street firms.
So they said December was pretty hard. January and February pretty good, and the end of February particularly good, and that's carried over into March.
Right.
So that's looking pretty good all in. And fixed income trading especially, which is where everyone makes their juice these days, was up 141% on the fourth quarter.
It's always hard to kind of make the read-across argument. Obviously, Jefferies business is slightly different. It's cash business, and they, it's not apples to apples, but obviously everyone seizes on this.
Well, the trend is pretty good. I mean, they're not building as much as they used to. Like that, they've added Prudential Beige, the futures trading firm, but that didn't perform particularly well compared to what they're expecting. So it's not, considering it went up that much, it's not a bad read-through. Investment banking revenues are up pretty good as well.
And so we're getting a bit of a proxy on what Goldman Sachs and Morgan Stanley.
As much as we can read.
What are they saying? Anything about March? Is there any sort of
Yeah, just that what happened in February carried on into March for a couple of weeks, so it's looking all right.
It looks like if we take Jefferies, some of what they're saying, both and as well as what we're seeing in the markets in terms of flow and volumes, and certainly rising stock prices, it looks like we might have a pretty good first quarter for Wall Street.
Yeah, we'd already seen some of that in those indications coming through already. A lot of the analysts have been saying that the securities firms have done well, relatively speaking. But here's the thing: you've got two of the biggest things, which actually they even mentioned, Jefferies mentioned on their call, is that you've got the European intervention through the ECB. The LTRO has helped boost asset prices and trading, as has the bailout in Greece. So those two things, which they're not going to be recurring events.
No, but they've lifted all boats.
They've lifted all boats. Now Jefferies admittedly makes most of its revenue, probably more than 80% from the US, so it's not as if they have to worry so much that it'll suddenly tip off. But for those,
but it was
firms,
the big concern that in November or so, or in fall, when they were getting they were getting clobbered.
They had some sovereign debt exposure, but it's relatively manageable. But for the other firms, there's a bigger issue for them, of course, especially the European firms who've taken money from the LTRO. What do they do with the money that they're making from government help? Do they keep it? Do they return it? That's one of the big issues.
There's also less of a sense of the investment banking business. I mean, there is a little bit of noise kind of going on in the IPO market, a little bit of uptick in M&A, but there's really we're not seeing sort of in the underlying investment banking business a lot. That's
I mean, Jefferies did okay, but they're more middle market, and they're growing still in that business, getting a few mandates they would have got a couple of years ago from securitization through the IPOs, M&A mandates. So they're not doing too badly. But I mean, here's the thing: though, you look at their results, it's still a less than 10% return on equity, which is far better than it was at the end of last year for most of Wall Street. But that means what? It means that people basically think that they're going to beat their cost of capital from now on if they're lucky.
Or if they're lucky, they meet their cost of capital.
Maybe it gets better. I mean, Jefferies is trading at 1.2 times book, so people now believe their balance sheet and they believe they're going to make a return on capital at some point in the future.
No, so that is stabilization.
That valuation is a little bit better, obviously, than we see for some of the bigger firms. But
we got to call it quits. We'll be back with more breaking views tomorrow.